With so much going on in the precious metals market, we especially need a voice of reason to cut through this clutter. And to provide it is none other than Rick Rule, President and CEO of Sprott US Holdings Inc. An internationally acclaimed expert on the financial and commodities markets, you can frequently find Mr. Rule leading industry conferences. Additionally, his insights are sought after throughout mainstream business media networks. And what Mr. Rule has to say is frankly both encouraging and alarming. Although he foresees a massive bull market ahead in gold and silver due to high-level government usury, the reality is that precious metals will be again subject to collective investor insanity. Therefore, he recommends a careful, deliberate approach to physical bullion as well as precious metals mining stocks. We've detailed a core list of potentially explosive ideas, which you can find at crushthestreet.com/4W. While we're in the early innings of the precious metals market, the mining sector is still in the parking lot. This is a time to strike while the iron's hot. So please check out crushthestreet.com/4W. So without further ado, here's Rick Rule.
Hello, everyone, and welcome into crushthestreet.com. We got a follow-up interview with the one and only Rick Rule, CEO of Sprott Global. Someone that I've done, and listened to for years now, have a lot of respect for, a legend in the resource sector. And we're going to be discussing the most recent moves that we've seen in gold and silver and how it's pertained to the mining stocks, because really they're in a different phase than gold and silver. We've seen gold move first, then silver, and then, the mining stocks seem to start to get the message that, we're in a bull market. And I think there's a lot of reasons for that. There's a lot of post-traumatic stress from what has happened in the past. And it's going to take some time for people to believe this. And what I hope to do is anticipate what might happen during this bull market and be able to play it accordingly. And I can't think of a better person to talk about this with other than Rick Rule. So Rick, thanks for coming on Crush the Street with me today.
Always a pleasure, Ken. Thank you for having me on.
Well, it's impossible to predict exactly what will happen, but, I'd like to discuss what is probable, what's likely to happen going forward here. And, what would you say is happening right now with gold and silver? Why are we seeing this move start to take place? It's been really difficult to go past 1360 in the gold, but why have we moved past it? Why has it eventually taken place?
Ken, if you look back over 5 years of the interviews that we've done together, our message, Sprott's message, has been very consistent. The most important determinant of the gold price is faith in the purchasing power of the US dollar, as expressed by the US 10-year Treasury. The prevalence of negative real interest rates in bonds around the world, including the US 10-year Treasury, is, I believe, largely responsible for the strength in gold. Anybody who can add and subtract knows that modern monetary theory, the suggestion that you can just print specious currency and it has value, is the modern equivalent of counterfeiting. And global counterfeiting, $16 trillion worth of bonds with nominal negative interest rates, and more like $30 trillion worth of bonds with real negative interest rates are, I believe, responsible for almost all of the increase in the gold price. This has been a very consistent theme of Sprott's, and one that is borne out on 40 years of observation of the interplay between real interest rates, faith in the purchasing power of conventional savings instruments, and gold. Jim Grant sums it up very well. Jim Grant calls sovereign bonds worldwide, most bonds worldwide, in fact, return-free risk. He says of gold, at least its return is a good, honest zero. It's not negative. And so I think that those facts are responsible for the increase in the gold price.
Rick, I don't like to ask people what their price projections are for gold and silver, and I'm not going to do that today, but I'll ask it, a little bit different. what is a conservative upward price in gold and silver that you're comfortable with? That it's not necessarily a bubble price going to, but is there any sort of intuitive price target that you have in your head, based on the current circumstances, that you would say, hey, this is a realistic price for gold for me? This isn't a crazy price projection, but it's just something that, I feel intuitively makes sense for the underlying metals.
Ken, I don't. In fairness, that's not the way my mind works. I'm not intuitively a journalist, and I don't have a good sense of how narrative plays on investor psychology in a market. So a hard number, and I'm not ducking the question, I've attempted to answer it in the past without really very good results. What I would like to re-stress for your audience, though, and I think this is important because it's worth more than a number, is the rationale. Over the course of my lifetime, I have seen interest in precious metals and precious metals securities wax and wane. The truth is that precious metals and precious metals securities have about 0.5% market share among savings and investment assets in the United States of America. At the gold market highs in 1981, the equivalent figure was 8%. So interest in gold and gold-related equities over 30-something years has declined from 8% to 0.5%. The 3-decade-long median and means are in excess of 2%. I'm suggesting to you, Ken, that precious metals and precious metals equities will return to their 3-decade mean, which means that demand for precious metals and precious metals equities in the largest investment market in the world will, I believe, in the next 4 years, quadruple. What price does that give us? I have no earthly idea.
Well, I guess in that same vein, let's talk about this. I feel like there's still a lot of hesitation in the resource space, considering, the post-traumatic stress that many investors have seen. It hasn't been a long, sustained bull market, where mining stocks had this, Bitcoin December 2017 moment where, anything and everything starts to go higher. So, having said that, do you anticipate this bull market to get to a point where there's just an absolute frenzy? Anybody, there's just so much greed entering the space. All stocks seem to be going higher just because they have the word gold or silver in it. What stage are we in this precious metals resource bull market, and where do you expect it to go?
You've asked many questions in that, so I'll try to summarize. I think we are in the early stages of a precious metals market, and earlier yet in terms of the precious metals equity. The precious metals markets have just begun to attract the generalist investor. And the generalist investor is not in the precious metals equities markets yet. In fact, the up move that we have seen in the precious metals equities markets is as much a function of the believers not selling as they are additional buying pressure. Remember that there's both bid and asks operating in a market. So what we have seen is a succession in selling pressure as much as we have seen an updraft in buying pressure. It is also true that no bull market, including a precious metals bull market, does stair steps to heaven, goes straight up. This market needs, on occasion, like right now, to back and fill. Gains have to be given up, or some of the gains have to be given up. The nature of a hungry and healthy bull market is one that grinds higher rather than sprints higher. And that's precisely what we're seeing right now. This is a very broad-based, very tentative, very, very healthy bull market. The second part of your question is, will stupidity again reign supreme? And that's doubtless true. The precious metals narrative is one of the strongest narratives in the world. And this market, by this market, I mean this financial market worldwide, is these days much more narrative driven than fact driven. I think social media has a lot to do with that. People have the ability to feel and react to social media long before they've taken the time to get educated, which was occasionally what happened in past cycles. A lot has been made over the fact that the millennials, the younger people, are not yet in the precious metals market. And I think that's true. But I think the millennials are the most narrative-driven generation that we've ever seen, and the most social media centric generation that we've ever seen. I think the combination of the extraordinarily positive narrative around precious metals investing, the narrative-centric nature of younger investors and speculators, and the prevalence of social media and the ability of social media to generate a frenzy means that we may see one of the most insane, most stupid, most abusive blowout markets that we've ever seen.
Wow. Well, I guess to piggyback on that and to ask you another follow-up question, one thing that you're very popular for many reasons, but one thing you constantly remind us about, which I'm very grateful for, is that, bear markets are the authors of bull markets are the authors of bear markets. The last bear market we had in precious metal was pretty significant, pretty gut-wrenching. So would you anticipate, based on, past performance of the cycles that you've seen, that the bull market to be equal and opposite to the bear market that we just experienced?
I'm not smart enough to answer that question either. I'm anticipating a bull market that is somewhere between good and memorable, not necessarily only due to the incredible purge that we suffered in the bear market, but also due to the fact that the current economic circumstance, modern monetary theory, out of control expenditures, and negative real interest rates are the most fertile ground imaginable for precious metals, and hence ultimately precious metals markets. I need to say that it's important that your listeners don't conflate the stupidity that's taking place in governing circles with any need to be stupid themselves in a bull market. It remains true today, and it will be true for all times, that 90% of the junior mining shares are worthless. Ignore almost all of them and focus on the best of the best. The truth is that the way your listeners need to play this bull market, Ken, is if they believe gold and silver are going higher, start their portfolios with gold and silver, with the base assets. The best way to make money is to avoid losing money. The second step is to buy the highest quality companies that you can. At least 75% of your speculative assets in a precious metals bull market should be in high quality senior or junior, but start with the seniors, precious metals producers. Get to the wild side of the market, the place where you're looking for 10-fold gains or 20-fold gains with an amount of money that you can absolutely, positively afford to lose 80 or 90% of. And limit your participation in the most speculative juniors to that amount of money which you can afford to lose, both financially and psychologically, virtually all of. When you're thinking about your upside, always think about limiting your downside first.
And for the sake of further understanding, Rick, you mentioned a bull market somewhere between good and memorable. How do you quantify that? Is that going to be a time-based bull market, or is it a price-based bull market, or is it a combination of the two?
Ken, I hope you can link the email address I'm going to give you to this interview, because I will send any of your listeners who care the most remarkable chart I've ever seen in my life. It's a 40-year chart of the Barron's Gold Mining Stock Index. And if you look at where we are today relative to where the gold equities have been numerous times over the last 40 years, and then after that, if you will look at the percentage gains that the bull market participants enjoyed between market bottoms and market tops, you will see that a moderate recovery is 150% recovery. The median or mean recoveries are 400 to 500% recoveries. And the big recoveries are 1,000% recoveries. So I would suggest to you that if past is prologue, it doesn't need to be, of course, but if past is prologue, that we are sort of 15% of the way through a good recovery, which would be a 400% recovery. We are very early on if this is a great recovery. The truth is, from here, Ken, it doesn't matter if this is a good recovery or a great recovery. The upside in both of them is truly astonishing, and the chart will show you with unbelievable specificity where we are relative to historic highs and lows.
Well, that's powerful. We'll be sure to have the link for the email in the description area for anyone that wants to get that chart. Rick, let's talk a little bit about silver. It's one of the things I mentioned to you in our little brief pre-interview chat. Not very many primary silver producers in the world, mostly because silver is a byproduct of zinc, lead, copper. And so my question for you is, what's the best way to fully capitalize on, call it a silver move from where it is now at $19 to $30, or maybe back to its all-time high of around $50, if there's not that many vehicles to invest in silver?
Well, Ken, you hit the nail on the head. Historically, when gold moves, silver moves later, but it moves further, generally much further. So the first way to play the game is to buy some silver. If you think that silver is going to move, buy silver. But you mentioned capturing a bigger part of the move. By taking more risk and participating in the silver equities market, you take advantage of the fact that silver stocks, particularly good silver stocks, are very, very, very rare. The best illustration of that I can give takes you all the way back to the decade of the 1970s, when the silver price moved mightily from $1.50 an ounce to $50 an ounce. One share, which is around today, now called Coeur Mining, then called Coeur d'Alene, moved from 10 cents to $65. That illustrates the leverage that can be had when corporations execute business plans well in a bull market. I would suggest to you, Ken, that given the extraordinary upside available in silver equities, that your listeners concentrate their efforts on the best silver equities, rather than trying to capture all of the alpha among the great unwashed, those little penny dreadfuls that have silver mostly as a word on the name of the company in the share certificate, and focus their efforts on silver companies that have lots and lots of silver. I would suggest that there are as few as 10 investable silver equities in the world, and maybe 6 or 7 companies beyond that are sensible speculations for people who can afford to lose a substantial part of the capital that they put up in hopes of outsized gains. So emphasize quality, Ken, in buying the silver equities. The upside associated with the best is so good that it makes no sense to take systemic risk in the space at all.
Absolutely. Couldn't agree more, especially with the valuations that we've seen. And especially if you were in a lot of these companies as early as a month or two ago, you'd be seeing massive upside moves in the current environment. Rick, let's talk about a book recommendation I heard you mention in a previous interview you just did. You said Human Action by Ludwig von Mises was the most life-changing book you've read as it pertains to investing. I just started it. Would you be able to elaborate a little bit more on why this was so impactful on you and what you learned from this book as I continue to dive into it?
Human Action is a very important investing book, but it's a book about life. Human Action is all about the study of volition or human will. And von Mises correctly points out that people are ultimately self-serving, even in their communal or cooperative efforts. They do it to advance their interests as they see themselves. Understanding the nature of self-interest, understanding other people's point of view and being able to predict their action by understanding what those people see in their own self-interest, and then projecting that into cooperative circumstances. Your participation in a company, your participation in a community, your participation in a family or a marriage. That's what the book Human Action is all about. It is about the primary instincts of mankind as individuals and how a group of individually self-interested and motivated people can cooperate in a peaceful and mutually beneficial fashion.
Yeah, that's powerful. And I think I learned a little bit of that when I read the book, How to Win Friends and Influence People, how important understanding people is as it pertains to life. And, even when we give, you always learn, if you grew up in a religious environment, you learned about giving and the importance of giving. But from a practical sense, when you give, you are planting seeds, which ultimately is self-serving if you have the greater foresight of that. And even people like us who run businesses and part of different things, the goal is to give more value than we take. And when we do that, it is ultimately self-serving, and we win people over by giving more value than we take. And that was something that was really insightful for me reading books like that. But I can't wait to get into the Austrian mind of Ludwig von Mises deeper in this book. So let's wrap up this interview here, Rick, just with some closing thoughts on where we are in the precious metal sector and kind of, what you anticipate going forward here in 2019 as we close out the year, especially as we're going into the fall, because I know a lot of people are talking about a stock market potential issue here going into September, October. It happens every year. They worry about the volatility that comes in the fall, which have historically been when we've seen a lot of these, market crashes.
Ken, I would encourage your listeners to not think about their investments or their life in quarter by quarter sequences. I would encourage your listeners to understand that events in their life, including markets, take place over much larger time frames. Certainly, the time that you need to act is sooner, but the expectation of reward or the expectation of failure is something that should be regarded by your investors as taking place over years rather than months. One of the mistakes that I've made most of my life as a consequence of being, I would say, a very linear thinker, is that I confuse the words inevitable with imminent. I believe that the precious metals and precious metals equities go markedly higher in the 3 to 5 year time frame. I also believe that at least initially they will grind higher, that these markets will back and fill. Do I think that the gold price is going to go in the course of this year to 1,750 or to 1,200? Either could happen. Either could happen. And a speculator or an investor needs to be mentally prepared to endure the fact that a bull market can unfold much more slowly than one expects, and that 20 to 25% declines are commonplace. 10% declines are absolutely normal and expected. What's important for your listeners to understand is if the gold price goes from, say, 1,550 to 1,350, that move is nothing. It's an inhale or an exhale. What is important for your listeners to understand is that precious metals are moving in the context of negative real interest rates. And as long as we have negative real interest rates, the bull market will be intact. Very important that they understand that. Understanding the market in the near term is much less important than understanding your own goals and psychology. The truth is, over 40 years, I've learned that the biggest risks in investment markets are located to the right of your left ear and to the left of your right ear. That is, they're the mistakes that you yourself make.
Well, that's powerful. And I agree with you a lot on everything you said, but it will be interesting to see if we do come back to that 1350 level in gold. It'll continue to encourage that, grind in the bull market that you described, rather than it just spiking to 2,000. Everything happens at once. It's a feeding frenzy of greed, and it happens quick, and it all blows out, and then we got to wait another however long it is for us to experience this bull market again. I mean, it's going to take that backing and filling for it to have that slow and steady rise in the precious metal space. And I do hope that happens, especially for the sake of people to be able to experience it and to get in time, because a lot of people have just been burned by what has happened over the last few years, and it's going to take some convincing to get back in it before it's too late. Everyone's going to be more excited about $2,000 gold than they are about $1,500 gold, because they're going to believe it at that point. So, Rick, thanks for coming on Crush the Street with me today. If people want to learn more about what you do, the email address that you mentioned, please let them know what that is, and what they can expect to hear from you if they reach out.
Ken, I think it's important, as we discussed earlier, that your listeners concentrate their portfolio on the best of the best names. And in order for them to encourage them to do that, any of your listeners who would like to email me their natural resources and precious metals portfolios, I will rank those portfolios on a 1 to 10 basis, 1 being best, and return them via email. It's important that your listeners put both the names and the symbols in the text of the email, not as an attachment. Send that email to rankings, RANKINGS, @sprottglobal.com. We will rank the holdings 1 to 10 based on the best available information to the 180 investment professionals worldwide here at Sprott, and send those back on an absolutely no obligations basis. We will also, if asked, include the 40-year Barron's Gold Mining Stock Index chart, which is the best chart that I have ever seen to describe where we are in this market and where this market could go.
Perfect. And then that email address one more time, Rick, was?
Rankings, RANKINGS, @Sprott Global, SPROTTGLOBAL.com.
There you have it, everyone. Rick Rule of Sprott Global. Rick, thanks for coming on Crush the Street with me today. Really appreciate your time.
Always a pleasure, Ken. I enjoy this. We need to do it more often as this market unfolds.
Steve
We certainly will.